Scene script: central bank intervention. Can quantitative easing ever end? Central banks wield immense influence over the global economy, employing a variety of monetary policy tools to stabilize markets, control inflation, and stimulate economic growth. Among these tools, quantitative easing, QE, has emerged as a controversial yet powerful instrument in the central bank's toolkit. Quantitative easing involves the purchase of government securities and other financial assets by central banks, injecting liquidity into the financial system and lowering long-term interest rates to stimulate borrowing and investment. Initially deployed in response to the 2008 global financial crisis, quantitative easing was intended as an emergency measure to prevent a collapse of financial markets and spur economic recovery. However, in the years that followed, central banks around the world expanded their QE programs, leading to concerns about the long-term sustainability and unintended consequences of such policies. Quantitative easing has been a controversial policy tool, with proponents arguing that it was necessary to avert a deeper economic downturn during the financial crisis. While quantitative easing played a crucial role in stabilizing financial markets and restoring confidence, its prolonged use has raised questions about its effectiveness, side effects, and exit strategy. One of the key challenges facing central banks is the delicate task of unwinding quantitative easing and normalizing monetary policy without triggering market disruptions or derailing economic recovery. Tapering quantitative easing involves reducing the pace of asset purchases and gradually withdrawing liquidity from the financial system. However, premature or abrupt tapering could lead to volatility in bond markets, currency fluctuations, and capital outflows, posing risks to financial stability and economic growth. Prolonged low interest rates and expansive monetary policy measures can also fuel asset price bubbles, inflate debt levels, and distort market signals, creating vulnerabilities and imbalances within the financial system. As central banks navigate the complexities of monetary policy normalization, there is increasing recognition of the need for complementary fiscal stimulus measures and structural reforms to support sustainable economic growth and address long-standing structural challenges. The future of quantitative easing and central bank intervention hinges on transparent communication, data-driven decision-making, and a commitment to addressing systemic risks and vulnerabilities in the global economy. By fostering dialogue, collaboration, and policy innovation, central banks can navigate the complexities of a post-QE world and promote stability, resilience, and inclusive prosperity for all.